So next up is one of my good friends, JC Parets, who is here despite the fact that his house is about to burn down, no joke. He's going to do 15 charts in 33 slides. Hold on.
Thank you, Ian. And fortunately, my house, as of right now, has not burned down. So I'm saying there's a chance. And they opened up the gym. I just got a text message from my gym, which is a few blocks away, and it's open. So I think we're looking okay. So my name is JC Parets, and I rip through 5,000 charts every single week. And the nice folks here at StockTwits know that, so they said, JC, just 15, right? So it's hard for me to narrow it down to 15 because, there's a lot of misconceptions when it comes to technical analysis. People are like, oh yeah, Head and Shoulders this and MACD and all this garbage. The reason that technical analysis works is because what we're doing is trying to identify the direction of the primary trend. And if you look at 5,000 charts, it literally is impossible to not be able to identify the direction of the primary trend, right? So that's really what we try to do. It's not one magic indicator or one great signal. It is literally a weight of the evidence where if you look at so many charts from all over the world, it's hard to miss major themes, right? So I'm gonna try to show what some of those themes are. How are we doing? Are we 14 minutes? This is like the Academy Awards. They're going to drag me out of here. All right, so the first chart I want to talk about is the reason why I have been so unapologetically bullish since the summer of last year. And fortunately, one for the good guys, we have gotten it right, very right. And this is a chart of the London FTSE 100. So this is the Dow Jones Industrial Average of the United Kingdom. So I don't know, maybe top 3 markets in the whole world, top 5, right? But so important. So what we're looking at here, do we have one of these fancy? Ooh. So look, so here is the high in the peak in 2000. We retested those highs in 2007 and the market crashed, right, twice, like has been mentioned so many times. This is going to be Bitcoin soon, right here. I'm just kidding. So we have overhead. I'm just kidding. So overhead supply, right? Overhead supply and then overhead supply. And now we are breaking out. So we're talking about one of the most important stock market indexes in the world that has done absolutely nothing for 20 years and is just now breaking out. So when these idiots tell you that the stock market is long in the tooth or we've gone too far too fast, they're literally lying to you. One of the most important indexes in the world has done nothing for almost 20 years and it's just now breaking out. So I can't stand here and look at you guys with a straight face and tell you guys that I'm bearish stocks if London FTSE 100 is just now breaking out of a 20-year base. So this is the Dow Jones Industrial Average, kind of a big deal. This is 30 stocks in the United States, like 30 mega cap stocks. And I think we're going to 25,000. So it's just very simple, for you guys that are interested in math and Fibonacci and want to understand, go to allstarcharts.com and there's an education tab and I explain in a very simple way how we calculate these numbers. We're basically taking the high to the low and setting up that target. So I think we're going to 25,000 in the Dow Jones Industrial Average. And what I've been essentially saying is that I haven't thought that the market was going to go up a little bit. I've been in the camp that the stock market is going to go a lot higher, and I still think that. I still think we're in the early innings, and when people are like, oh, JC, what inning are we in? My grandfather once went to a Yankee game that went 22 innings. So, we can go on for a long, long, long time. So here's the Russell 3000. The Russell 3000 represents approximately 98% of all investable assets in the United States. So basically America, right? And we're breaking out to new highs. So I think we're going to 1600 in the Russell 3000. That's not a little bit higher. That's a lot higher. And when you look at 5,000 charts, you can see that in a lot of these cases, in a lot of the major important areas, our targets are not a little bit higher. They're a lot higher. So there's this overwhelming theme right now where people think that the market has gone too far too fast when I just think it's just getting started. I think it's got a long way to go to the upside. So here's the trannies, right? This is the Dow Jones Transportation Average. So you have the Dow Jones Industrial Average, which is 30 stocks. And like 130 years ago, this was the Dow Jones Railroad Index, but now we have other forms of transportation, right? And just a very simple 261.8% extension of the entire decline from the 2007 peak. Ian, you're blocking my charts, bro. So I think we're going to 11,000. And then here's chart blocking. I love that. So here's a closer look, right? So 11,100 is the target. Here's a closer look at that. But then what we're going to do is we're going to overlay another Fibonacci extension. And it gives us the exact same target from a different point. Again, if you guys are interested in Fibonacci, find me later. This is really simple math. I'm a very keep it simple, stupid kind of guy. But 11,100 in the Dow Jones Transportation Average, that's another 1,000 points in industrial stocks, airlines, railroads, the shipping companies like FedEx and UPS. Like, there's a long way to go. So no, I don't think that we are late stages. I still think we're early stages, and all these charts are showing that. So then we have this president, right? This guy, Donald Trump, right? So he, right, conveniently likes to tweet out when the stock market is making new highs, like kind of like he had something to do with that, right? So here we have in blue, we have the S&P 500, right, which is kind of like our America's index, right? And then here is the next 39 countries in the world equally weighted. So basically everybody not America. And the charts look exactly the same. So it's not that US stocks are going up because of what's happening in the US or DC or Coronado or New York. Stocks in the US are going up because stocks all over the world are going up, right? Not because of who the president is, but despite who the president is. So with that being said, emerging markets, right? You talk about, like, people are like, oh yeah, this is the 9th year of a bull market or 10th year of a bull market. No, this bull market just got going. Emerging markets have done nothing forever. You know, this is Brazil, this is China, this is India, this is Russia, South Korea, definitely not North Korea. The 2011 highs, that's where I think we're going. By the way, emerging markets peaked in 2011 and went straight down for 4 or 5 years. Like, that was not a bull market. When something goes down for 5 years, that's not an uptrend, right? So I think we're going back to those levels, and we're going to retest those 2011 highs. So this is my 5th chart. This is financials. This is arguably the most important sector in the world, right? If you look at a chart of financials going back forever and overlay the S&P 500, they kind of look the same. So it's very difficult for stocks as an asset class to fall too hard if financials are making new highs. And financials haven't even gotten back to where we were in 2007. So this is the Financials Exchange Traded Fund, XLF. And not only do I not think it's crazy to think that we're going to go retest those all-time highs, I think it would be crazy to not think it's going to do that. You know, this is like a magnet, and that's where I think it's going. So if bank stocks are going to go up another 20% from here, that's probably not happening in an environment where stocks are going down, right? So here's JP Morgan. This is the bellwether of financials. Again, did absolutely nothing for almost 20 years, and just now started breaking out. So 110 and JP Morgan, I think that's where we're going. So Citizens Financial, Cheplik asked me yesterday, JC, what stock do you like? Listen, I like stocks as an asset class. I like bank stocks as a sector. So then within that, I think CFG presents a nice risk reward. If we're above $35 a share, I think we need to be long, and we have a target of 45. Again, that theme that it's not going a little bit higher, I think it's going a lot higher. So it's not like this one chart that is like, oh my God, the market could go a lot higher. It's every chart that's suggesting that we can go a lot higher, right? So I was just talking with Jeff Mackey back there. Jeff, how you doing? These are retail stocks that I think, suck. So, stocks across the board look great, uptrends everywhere, all those things. But some of these retail stocks, Best Buy and things like that look great, but some of them look terrible. It's almost like they didn't get the memo that stocks are like in ridiculous uptrends, right? So here's Macy's, right? I don't know if you guys can see it. You can just email me and I'll send you these slides later, but jc@allstarcharts.com. Macy's, this was our target. And, right around $21, and it hit that target several months back, and it hasn't bounced. So when a market hits your target and doesn't react to that, in all likelihood, it's probably going to continue. So if we're below $20 a share in Macy's, I think it's a short, and not like a light short, like aggressive, like very aggressive. I think it goes to 5, and if it goes to 5, it's probably going to 0, right, Jeff? You know what I mean? What's the difference? Ulta Beauty, I don't really know what they do. So ULTA, I assume it's some sort of beauty company or something. But the chart looks terrible. And, I think that if we are below that 225 level, if you will, I think you short the hell out of it. And I think we're going to 170. So even in a raging bull market, there's still garbage out there that we can short. And I think these are just two good examples, particularly in the retailers. Like that's where you can find risk reward opportunities on the short side that are uncorrelated with the rest of the market. Like clearly these guys like have no idea that we're like making all-time highs in stocks, right? So here's gold. Speaking of like shitty, it's not an uptrend, obviously. We are in a severe downtrend in gold, and I'm going to bring this up for a very important reason. Again, it's not an uptrend, right? This is the silver gold ratio. You want to know where precious metals are going? Look at silver gold. You want to look and see what the crazy people are doing, right? And the crazy people don't buy gold, they buy silver, right? So if there is risk appetite for precious metals, they're going to be buying silver at a much more aggressive rate than if they were buying gold, right? So gold goes up when silver's outperforming gold, right? That's evidence of risk appetite. But that's not happening. We're still in a downtrend. So if you want to be a buyer of gold, right, and you don't care about Bitcoin, you want to hedge your life in a different way or whatever, you want to start seeing silver outperforming gold. And we're not seeing that yet. Now, copper versus gold is a different story, right? This is a great sign of the economy, right, supposedly. This has been in a severe downtrend for a long, long time where gold has been outperforming copper, and this is now changing. So the beauty of technical analysis is that we can take one chart and then put another one on top of it, especially when you're only given 15. So here we're looking at the copper gold ratio, and on top we're looking at US 10-year yields, so US interest rates. The charts look exactly the same. So if copper's breaking out relative to gold, there's a very high likelihood that interest rates are also going up, right? 10s look like they're going to 3%. That's good for banks. So you're noticing this theme. Stocks look good, banks look good. We want to be long banks. Higher interest rates is good for banks. We're looking at a copper gold ratio to buy shares of JP Morgan. That's called intermarket analysis. So in May of this year, I looked at what I thought was the most bullish chart in the entire world. It was consumer staples relative to the S&P 500. Consumer staples is the stuff we're going to buy, whether the market's going to 0 or 100. Toothpaste, beer, cigarettes, like all that healthy stuff, right? Consumer staples is that. So it's a more defensive play relative to something like consumer discretionaries or financials or tech, right? So in May, I'm like, oh my God. Consumer staples relative to the S&P 500 are putting in like a major top. If this thing crashes, stocks are going to rip. So this is the ratio up top. You can see how it looks exactly opposite to the S&P 500. So I'm like, oh my God. So this is May, right? I'm like, dude, if this crashes, we're going to rip in stocks. And then this is what it looks like now. It just broke. So if money is fleeing the safe asset to be more aggressive in the aggressive asset, that's evidence of risk appetite. And that's why the XLP-SPY ratio looks exactly opposite to the S&P 500. So if we are crashing, which is basically what's happening, that money is going into stocks in an aggressive way. So if you want to know how aggressive you want to be, this is the chart, staples, S&Ps. Two old school names that like the millennials, I don't know if you guys have heard of it, Cisco and Intel, they were like a big deal way back in the day, but the stocks have done absolutely nothing for like 15, 16 years, and they are literally just now breaking out. So I think both Intel and Cisco are gonna go retest those all-time highs from 1999 and 2000. Again, that theme, that's not a little bit higher, that's a lot higher. Bitcoin, everyone's best friend, right? People talk about Fibonacci. I mean, dude, does it get any cleaner than this? We broke out from the high in 2013. So we take the 161.8% extension of that. We broke out, we retested it. We broke out above the next extension, retested it. I mean, this is like to the penny. So from a risk reward standpoint, I think we could go up to 7,400 in Bitcoin, but we only want to be long if we're above 4,600. Again, we're not here to be right. We're here to make money. There's a big difference. So I don't care if Bitcoin triples or goes to 0. I really don't care at all, right? Jenny from the blockchain back there, like she might get upset at me for saying that, but I really don't care at all. But from a risk reward standpoint, I love it long. I really do. So here's a closer look. If we're above 4,700, 4,700 is the deal. If we're above that, we want to be long with a target of 6,500. That's a great risk reward. Let it go to zero after that, right? So here, people talk about the Dow Jones Industrial Average and everything like that. I created an index called the Nasdaq 30, which is the top 30 stocks in the Nasdaq, which if you add it all up, represents 50% of the entire market cap of the Nasdaq. And it's not a downtrend, right? I think we break out and we continue to go higher. The discretionary stocks that I like, by the way, this is chart 13. I got Taylor here crossing out. So there's 4 stocks that I want to show you. Amazon is in an uptrend, obviously. Expedia is in an uptrend, obviously. Priceline is in an uptrend, obviously. TripAdvisor, not an uptrend, right? So we want to identify these stocks that are doing basically the exact same thing. We want to be buying the strength, not the weakness, right? You have people that want to get cute and buy the garbage. No, you want to be with the institutions. The institutions are looking for momentum and they're looking for relative strength. TripAdvisor is not that. All of these are. We want to be buying these 3. We don't want to be buying this one. So credit spreads. If the stock market's going to crash, you're going to see it in credit first, okay? So there's no deterioration in credit. To the opposite. We are seeing strength and risk appetite, not risk aversion. So this is junk bonds versus U.S. Treasury bonds. If you think there's risk appetite in the stock market, you want the bond market to confirm that. And this is the ratio that you want to look at. I think we break out in the ratio of junk to treasuries. And then I think we break out in the ratio of junk to investment grade, which is apparently not junk, right? So if there's risk appetite for stocks, there needs to be risk appetite in the bond market too. So this is chart number 14, and it is both the junk to investment grade and the junk to treasuries, and I think both break out. If we do get those breakouts, I'm pretty sure I'm going to be right on all the other stuff. If they roll over, then I'm probably going to be wrong on all the other stuff. So these are the charts that we want to look at. And then the US dollar index, major base, right, in the US dollar index, and I think we're retesting this support. I think dollars are a buy, and therefore British pounds are probably a sell. So look at this support in British pounds in the early 90s, again in 2001, again in 2009, and then we broke. Former support turns into resistance. I think this is a fade. If we're below 135 in British pounds, we want to be short, and we want to be covering at 112. And then finally, Taylor, I'm getting that look. I know when women give me that look, I know what it means. So this is Tesla. I know all you junkies out there love your Tesla. So the way I learned it, the bigger the base, the higher in space. And no pun intended, though. So Tesla has gone absolutely nowhere for about 3 years and just broke out to start the year. Hit exactly the 161.8% extension of that range and stopped. Right? So you guys might not care about Fibonacci, but clearly the market does. So we pay attention. So moving forward, I think the higher likelihood is we break out. If we're above 385, we want to be long Tesla with a target of 535. And for you guys who are not totally bored by this, I go to allstarcharts.com/Stocktoberfest, and it's like a great discount, and you get 30 days risk-free, and you get to listen to me more if you're into that sort of thing. And I'll be here like boozing in the back. So, thank you.